All right, good morning, Checkmate crew. It's 30 minutes after the opening bell of the New York Stock Exchange at 10 a.m. Eastern Time on this Thursday, December 29th, 2022. Yours truly, Mickey Blindside, here with your market memo. Today is the last day of the market memo for the year. So hopefully we'll be able to today the hope is that we go over all the things that have worked and all the things that have not worked for 2022, and also looking forward to what is happening in 2023. So today is really like a year in review, what has worked, what hasn't worked, and then also looking forward to 2023, okay? So let's dive right in. Somebody just mentioned on chat that my sound isn't working, but it does seem like it is. Let me know if it's still not working. Just put it in the chat if you hear me or not. But okay. Also, if you can't hear me, you can also go to our Discord. I'm also streaming live on Discord as well. Okay. Anyway, today, just as a recap of what's going on here, just to stay current. Right now, the S&P 500 looks like it's trying to make a gain here. One of the things that has worked this year is really waiting and being patient for clear levels to act within the market in the direction of the predominant trend. And so this year, the predominant trend was down, okay, obviously, all right? And so we kind of saw that. For those of you who follow on Twitter, or for those of you who followed me from the from our past Discords, you know that we developed this trend, and we were well aware of this trend since around February or so. Around November, December is when I said, junk bond credit doesn't look very good. It looks like, we may be in for a rough year. And then we established that downtrend in February. And so acting in that predominant trend and waiting and patiently waiting for those value levels was the way to go. Okay, that seemed to be the way to go, and that has worked out really well for us. My biggest trade this year was this one right here, where we in April and March, buying those put spreads that were 3 months out. I believe I bought for June or July right here, and I held it for more than double. All right, that was my biggest trade this year. That was the highest conviction short I had all year. It was like screaming short, and a lot of that came from our junk bonds advanced decline line, which was also something that has really helped us a lot in 2022, and I think that in 2023 it will continue to help us. And for those of you, you can always go to our YouTube, go to our special sessions playlist, and go to our junk bonds advanced decline line episode, where we go over why it works, how to use it, and I post on our Discord every night the update and the updated advanced decline line chart. And you guys are free to use it. You can join our Discord for free. There's no paywalls. There's no subscription fees or anything like that. I do it all for educational purposes. All right, and so that has worked out really well for us. It was a screaming sell right here to buy puts, and we were able to capitalize on that. So I leaned into this trade really hard. Now, the next ones after that, psychologically, it became harder and harder. With these bear market rallies, it became harder and harder to really psychologically commit to going through with the plan. So that's something that that's an opportunity for growth on my end, is to really stick with the plan. I mean, of course, when you wait for the edge of price structure, always when you act, it's always the scariest moment, okay? And that's usually the best trades are the ones that are the hardest to place at the time, okay? That's just something that I I've experienced through trading for many years. But it seems as if, you know, that was one of the biggest barriers this year, was really the psychological aspect, and these huge swings up and down made it very difficult. You know, if you were wrong, it could have cost you a lot, unless you were patient and you waited right at the edge. And then if you were wrong, you could just get out at a very small loss, okay? And that's why being patient was one of the hardest things, but it worked very well for us. Those of you who were not patient ended up seeing large drawdowns in the account. I wasn't very patient when we started loading up puts in the summertime, in the June, July, August sessions. That was where I didn't exercise that much patience, although those trades did work out for us and we ended up doubling what we were at risk for. You know, I faced some drawdowns initially, and that made me gun shy on my position sizing. I remember right around here, you know, I put about 6 or 7% of the portfolio of my speculative account at risk on put spreads, and we were able to double that amount. But, you know, around here, when I had high conviction and when I actually exercised patience, I was able to lean into that trade a little bit more. Actually, just shy of about 50% of my spec account I was putting into those 3-month puts. You know, and that's because I was leaning into this, and not only that, those put spreads act as a hedge on my long-term portfolio, so I'm more comfortable doing that when it's hedging my long-term portfolio. Okay, so this one we were able to capitalize. We were patient. We leaned into it. In June and July, we kind of front ran it, and so we faced a drawdown. Luckily, we had about 3 to 4 months on our put spreads, and we were still able to capitalize on that. So really waiting for those high value levels really worked out great for us. However, when you do wait for those high quality signals, you tend to miss out on a lot of trades too. So we missed out on a lot of trades. There were some trades that we could have taken, but we just didn't, because we never, well, at least for me, I never really got my value levels. But that's okay. And I think this year, if you made money this year, you did pretty good. Okay. Most people that I know, most professionals, okay, that I speak with and that I confide in, you know, they've had a really tough time this year. And some people actually exited the business altogether because of this year. And so if you made money this year, I think then you're doing pretty well. And this year, you know, I'm happy to say that I'm continuing my win streak, at least on my speculative account. I haven't had a losing quarter in my speculative account since about 2017 or so. So this year has been a pretty decent year. Most of my profits again came from that March April short, you know, all the way down into the summer. That was the most, you know, the most profitable trade I had this year. You know, waiting for those value levels really did make a lot of sense. One of the value levels that we should have participated in, but I ended up not doing, was the Japanese yen. I was talking about going long the Japanese yen. This is the US dollar Japanese yen chart. So this chart would be long US dollar, short Japanese yen. So when this is going down, the Japanese yen is actually strengthening. Okay, so we were going to go long on the Japanese yen around here or so. All right, if you want to look at it on a futures chart, on an inverted chart, okay, actually going long on the Japanese yen. We were talking about going long here, and that was our value level. We were being very patient, but then we saw this. I saw this, and it freaked me out. Okay, and I never got in because of this. But if we had gotten in, and if we had actually gone with the plan that we had originally set forth, this would have been a banger. I'm talking like this is like the equivalent of holding on to a 500-point move in the S&P 500. Okay, it's like something like that, 400, 500 points. And if you don't know anything about S&P 500 futures trading, each point is about $50 on one contract. All right, so we're talking like per contract, like 25 to 30 grand. And the 6J contract, it's got a pretty low maintenance margin. So the initial margin, I believe, is like something like $2,000 or something like that. So I mean, this would have been a banger if we had actually gone through with it. And again, it's really being patient and being disciplined and acting on that plan. Okay, it's the patience to wait for your reward to risk to be in your favor, and then the discipline to act on that plan once you get that edge. All right. I just did not. I was patient, but I just didn't have the discipline to go ahead with it. And again, because it was just really scary right here. The Japanese, the Bank of Japan announced all of these crazy measures then. And that news risk and also the price action risk, got me, a little bit scared. But again, if we had actually had the discipline to stick with the plan, with the original plan was to get long here, right at around that, I believe we were trying to get long on like 6. It was close to 0.00600. That was where we were going to go long. I believe I put it just a little bit above. I think I put it at like 665 or something like that. So we would have been able to catch that, and we would have profited immediately from that. Unfortunately, though, I just didn't exercise that discipline to go ahead with that plan. Speaking of the Japanese yen, just to mix in with some current events in here, the Bank of Japan just announced unscheduled bond buying again. They also, just like our Fed has all these news events and meeting minutes where they explain what happened in the previous meetings. The Bank of Japan also had an announcement, a clarification, if you will, about the bond band that they increased, from 25 basis points to 50 basis points. And, the market initially thought that was a step toward normalizing of the monetary policy. So right now, most of the world's central banks are hawkish right now, and they're tightening, or they have been, at least for the last 6 to 7 months. But the Bank of Japan has been one of those central banks that has not been hawkish at all. No tightening. They have actually been increasing their loosening of monetary policy. So people thought that this was, okay, finally, they're getting on board with tightening. But that was not the case. In their announcement, they said that, no, this was to help facilitate the bond market. And they actually said that there is no plans to stop their current policy of easing. And then now today, or in the last 2 days, they've announced, I believe, 2 unscheduled bond buying operations. Okay, so they're still injecting liquidity and cash into their markets. All right. And so it doesn't look like this is going to change until they have a new governor. Right now, Bank of Japan's the head of Bank of Japan right now is this guy named Kurata. He is known to be very, very dovish. We'll see what happens. Right now the Japanese yen is strengthening. There is a belief amongst those who follow the Japanese yen and the Japanese bond market. There is a belief that the person replacing Kurata, and Kurata is expected to leave sometime in March or April. There is an expectation that right now the front runner to replace Kurata is as BOJ governor. His name is Yamaguchi. And he is known to be very against the current regime, policy regime. So he, Yamaguchi is I think is going to be more of somebody who wants to tighten monetary conditions. And so if that's the case, I don't know if the market is front running that or what, but as of now, the BOJ is saying that there is no plans to change any of the easing policies that they have. Now, when we get this new Yamaguchi, if he is to become the new head, again, with the with the Bank of Japan, kind of, they're not like the Fed, the Federal Reserve. The Federal Reserve will usually broadcast any type of changes or anything like that, staff changes or change in policy way in advance, all right? And they usually stick to it. The Bank of Japan is very notorious for throwing curveballs at investors and at the market. So we'll see what happens. But right now, amongst those who follow the Japanese yen, right now the likely candidate is Yamaguchi. And again, he has a very, very different view on what is right for the course of action for the Bank of Japan. So we shall see. And I think that's something that we will have to monitor as we get closer and closer to the end of Q1, beginning of Q2 of 2023. I think if the Japanese yen really starts going up and tightening, we could see the dollar drop, and we could see a big rush into the precious metal space. I think it's going to be a domino effect. And we talked about this domino effect actually in September and in October as well. We talked about this. We talked about this for months. So a lot of the things that we're talking about today, we've actually been anticipating for a few months now. I think there will be a domino effect. If the Japanese yen keeps going up, the dollar will drop, and then all this money will, I think, rush into the precious metal space, which, by the way, is a trade that I'm looking into, and I think that's going to be a very, very profitable trade for us in 2023. And I'm just waiting on a good opportunity to get in. One of the reasons why I'm also very bullish on the precious metals space right now is because retail is just not getting on board with this. Retail, usually when we see, everybody thinks retail is wrong. I would say that is a mistaken view. They're not always wrong. I would say that the crowd is generally right. The crowd is generally right, and that's what the market reflects. The market reflects the crowd, and the crowd generally gets it right. Usually in a trending market, the crowd is right, all right? I would say the crowd is wrong about 25% of the time. 75% of the time, we're in this trending market, and people are just going with the trend. The crowd goes with the trend. That's fine. Usually, the crowd is right in that. But when the trend reverses, that is usually when the crowd gets it wrong. Okay, that 25% of the time when the crowd is wrong is usually a trend reversal. Right now, there's very little retail participation in GLD ETF. Okay, so if the crowd were jumping in on this, I'd be a little bit more skeptical about this trend reversal, this long-term trend reversal here. But retail is really not participating in this and getting on board with precious metals. So, with that, I think that if there is a trend reversal in gold, it will be not as participated in, which is in the short term, which is good for us. Generally that means that there's more returns for all the participants. So I really want to get involved in this, okay? And you guys know how I feel about this. I'm trying to get in on the silver miners. I think the silver miners are really going to explode to the upside if Japanese yen just keeps going up and the dollar keeps going down. Speaking of which, we still have those UUP hedges. They're good for 2023. They expire in January 2024. We shall see. I really would like this to at least temporarily for the next couple of weeks or so, maybe a couple months, for it to have a retracement, and that would be a very good opportunity to exit our hedge as well as get involved in the silver miners. And again, you guys know my plan. I'm going to cash out of those hedges, and with that hedge money, I'm going to buy some leaps on the junior silver miners, SILJ, and sell poor man's covered calls on a weekly basis on it. So I think that's something that we can look forward to, and I think it's finally happening. And again, we've been anticipating this back from September, October, and finally, I think we're seeing at least the setup play up. The setup is actually playing out. Unfortunately, I wish I had gone in on silver a little bit earlier. Right here, I was contemplating going in a bit early. This is one of those things where being early would have profited. But again, for every one of these stories where being early would have been a great move, there's always like hundreds of other stories where being early makes you wrong, okay? And so that opens you up to a lot of drawdown. And so, number one rule as a trader, and I keep saying this all the time, is protection of capital, okay? You need to protect your capital. And so if the price of being wrong is too high, that's probably not a good trade to take, because nothing is for certain. There's no crystal ball to this. There is no guarantee that actually what you want will happen. So got to keep that in mind, okay? So again, something to look forward to in 2023. Also, something that we've been talking about for a while is also the weakness in emerging markets. I do think that this will take some time, okay? Especially if the dollar does drop in the first half of 2023, that's going to be tailwinds for emerging markets. However, I do think that will change. I do think that at some point we do see inflation come back and we will see the dollar strengthen again. I think that happens more toward the end of 2023 and beginning of 2024. Definitely the effects will be at least that point, but we may see the dollar strengthening maybe in the mid to end of 2023. And if that's the case, that sets up another slew of opportunities as well too for us and for those that know and they can track this. So, right now, one of the things that we've been using as a inflation indicator is the TIP-TLT ratio, which is the inflation protected treasuries divided by the long-term treasury ETFs. So TIP is the inflation protected treasury ETF. TLT is the long maturity ETF. And this ratio gives you an idea of what the market is expecting as far as future inflation expectations are concerned. And we saw it back in 2020, in 2021, we saw this really make on a weekly chart. We saw it make that higher high, higher low, and it just kept going up. And that was one of the key indicators that inflation may stick around and be a sticky problem. And so this was also one of our indicators that told us that, hey, we may be in for a rough 2023, this and our junk bonds advanced decline line. But right now, this was a very good indicator until around September or so. And then the last round of that inflation protected treasury auction had huge bids and huge demand, especially from the retail realm, because it was the last inflation protected treasury auction with over a 9% yield. All right, and so it was like there was so much retail participation in it, it really drove up TIP. And so I think this part was the anomaly. It came back down as bond markets normalized, and we came back to this box. And, this is a box that we've been talking about since May. And it's been in this box, and now it's trying to push out of that box on a weekly basis. I do think that this will probably start trending up if we see commodities come back. And I do think it comes back around that planting season, March, April. We've been talking about that also for at least a couple of months as well, too. I do think that we do see commodities come back, especially if the dollar comes down in the first quarter. We could see commodities really roar back. And in the summer, if we start seeing commodities really start breaking out, then we can see TIP, TLT making that higher high and higher low and then trending up again. And if that's the case, the Fed will notice that. And then if we start seeing spikes, I do think that, after maybe the January and February readings, and for CPI, I do think that CPI will probably spike. I don't know when. I just don't know when that's going to happen, but I can see it happening sometime in April or maybe in the summertime with, us seeing like surprise little spikes in CPI. All right. And then we will see what happens at that point. Perhaps we change our Fed funds expectations at that point. But if inflation roars back by the end of 2023, I mean, you can pretty much, I think you could pretty much assume that the Fed will have to start some type of tightening regime again. And on the second time, it will probably feel a lot worse. All right. And I think that expectation really hasn't been baked into the market, because if you actually look at the Fed funds futures probabilities, if you look at the probabilities right now, we're still expecting, a 25 basis point rate hike for February, another 25 basis point rate hike in March, and we're going to stay at around 5 or so, and that's the expectation, to stay at 5, and then we see the possibility of a rate cut perhaps towards the end of the year in December. All right. Now, if inflation comes back in the second half of 2023, I think this will shift. And then, again, we might see a little bit of volatility around that. But with that, volatility, though, I think that will happen closer to the second half of 2023. Right now, what I see is in the first half of 2023, I see us having the possibility of having a mini rolling bull market. And that has to do with the tax selling that has happened in the last 2 or 3 weeks. We've seen the biggest winners and the biggest losers for the year getting sold off at the same time. I had a tax selling thesis 2 or 3 weeks ago, and we got into our XLP put spreads, which we made a decent 25%, 20 to 25% on. That has worked out well for us. Now, most institutions try to avoid wash sales. So after 31 days of all that selling, I think they're going to start getting back into some of these beaten down names. And I think one of the sectors that may have some focus from institutional investors is semiconductors and the tech space, especially around February. Now, tax selling will end today, okay? Most institutions don't use margin. They trade on a cash basis. So they will have to exit their positions today so they can get settlement by tomorrow, by the end of tomorrow. And so a lot of that tax selling will be completed today. We saw a lot of tax selling actually yesterday and the day before and this week. So a lot of tax selling actually happened later this year than in most years. Most years it's usually around the end of November, beginning of December. But this year it was more mid-December to end of December, which means that 31-day period is going to happen around end of January, early February. And if that's the case, that's when I think that we see institutional bids come back into the market, and that's when we may see that mini bull market. It could last for a few months, all right? And then I think the secular bear market trend will re-exert itself towards the end of 2023. At least that's what I'm preparing for. Again, I can't tell the future. You can't tell the future. Nobody can tell the future. There's no crystal ball to this. However, like a good chess player would, I'm anticipating 5 to 10 moves ahead. There's no way to predict what your opponent is going to do, but still the good chess players try to move 5 to 10 steps ahead, right? And so that's what we're trying to do. We call ourselves Checkmate Trading for a reason. All right. So that is my expectation going forward. And I am still, my thesis still stands. Right now, the trading plan that we have matches that. And so now it's all about just the patience to wait for those levels and the discipline to act on it once we get there. Okay. And so I think next year, I think the plan really is get in on some of these commodity names. We've been talking about this for a while now. The SILJ, I think commodities is still going to be the place to be. CPG, at some point, I do want to get involved in this name as well too. Hopefully we see, some drawdown in oil or natural gas prices in January, February, as we get to kind of the spring season, where the January, February months, generally we see oil kind of and energy prices kind of cool off a bit during those months. And if we can see also diesel supplies go up around mid to end January, I think that would put some pressure on oil prices, and we could see some of these names come down a bit, and I'd be a buyer at that point. CPG, we're also looking at AR and Taro as well too, which is a big natural gas supplier. I think this will also be a good performer. So energy, precious metals, and also the tanker names. Right now, I believe FLNG, we're in a slight drawdown. I think our calls are down about 6% or so. So I should have sold some covered calls right here, but I thought it would actually break out and move up again, but that was not the case. I'm still willing to hold on to this. I have 2 years on this, and it's deep in the money. Right now, they're Delta 75s, Delta 70, 75 or so. So I'm willing to hold on to this. On the next pop, though, I will be selling some covered calls on this. And I do think that for the next 3 or 4 months, we do see a continuation of this trend in some of the energy and some of the energy carriers. And some of the energy tankers as well too. FLNG is a name. STNG is another one. STNG almost came down to our levels, but not quite. There's some other names as well too in tanker spaces. If you want to get into the energy tankers names, there's a lot. There's a good number of them. I wouldn't say there's a lot, but there's a good number of them, and some of them have very, very good earnings. They've been increasing their dividends. They're increasing their free cash flow. So this seems to be a good place to be in right now. If you want to get into more of the dry bulk carriers, SBLK is one that I really want to get into. I think this is a very good bulk carrier, a dry bulk carrier as well too. And with China reopening, again, I think that's going to be a big Q1, Q2 kind of story. We definitely want to take a look at the Baltic Dry Index and see that it's making a higher high, higher low trend. Right now, let's see, BDI. This is the weekly chart. We shall see if this continues or not. I'd like to see it make a higher high and then come back, make another higher low, and that would be a pretty good indicator of what's to come for the dry bulk carriers. Right now, since we're talking about China, Australian dollar will show us the way. The Australian dollar has been really resilient, although today I do think that it's right at our edge or make or break moment right now. Yet again, that level has been just a very important level for us in the Australian dollar. Oh, it's above it now. It's above it. Okay, so right as I started, I noticed that it was literally teetering on this line, this make or break line from earlier this year. Now we're over it. And again, you know how I feel. If it gets over that 690 level and remains there for at least a week or two, Chinese stocks are just going to go crazy to the upside. And I do think that, with their opening and with all the easing that they're doing, I also posted something on Twitter last night on the reverse repo facility from the People's Bank of China. Right now, they're just injecting a lot of cash and liquidity into the market. Right now, the overnight reverse repo rate is at its at a low right now. So they are facilitating as much liquidity and cash into the market as possible right now. And I do think that we see that stimulus work into their equity markets. We're probably going to see their equity markets go up, at least in the short term. China is a trade. I wouldn't invest in China, but China definitely is a trade onto the long side right now. However, again, looking now, not just looking 5 or 10 moves ahead. Now I'm looking more like 15, 20 moves ahead. What's going to happen, though, if China has increased inflation at the end of 2023? Okay. What if the Chinese inflation is super high and global inflation also roars back at the same time? I don't know if that's going to happen or not, but that's definitely within the realm of possibilities, and that's something that we will have to monitor. And again, I think that's going to be closer to mid to end 2023 when that happens. I could be wrong. Maybe it happens sooner. I don't know that, but the data will tell us. And of course, as always, I will share what I find. I see somebody chatting with me. Somebody said housing is still going up in BLS data, even though it's going down since April 2022. Usually housing has 12 to 18 months lag. So next year CPI can actually go down to 3.5 by mid 2023. I do think that CPI is still going to come down, at least for the January, February readings. And again, when I said the spike is potential spike in CPI, we need to see the commodity space come back too. So around March or April, I am anticipating during the planting season that the commodity cycle will restart and we'll probably see another rally in commodities. CPI is lagging data, okay? So yeah, I think until like the summertime or so, we don't really have to worry all that much. But after around like April, May or so, if commodity prices keep going up from now, let's say, we might start seeing little spikes in the CPI data starting in the summer or so. Maybe a little later. If commodity prices don't really firm up until like late March, early April, then we're talking more like closer to Q3 or end of probably Q3 or so that we might see a spike in CPI data. And again, I don't have a crystal ball to this. I'm just trying to think 5 or 10 moves ahead. So it may not come out, it may not come into fruition, but I'm just trying to anticipate ahead and getting my mindset right, because if we do participate in this mini bull market for the next couple of months, I think it's still very important for us to manage risk and collect profits on the way, because when we see these CPI reports, if we see a spike in it, we could see some large drawdown days in the market around those CPI prints. I'm just trying to anticipate and trying to just to get in the right mindset to manage risk, all right? And of course, this could all change based on changes in market behavior. If what we anticipate doesn't come out to be true, then of course we will have to change our thesis and pivot our strategy for that, okay? So yes, I do think that CPI data is still going to come down for the next, at least, I would say, let's say a couple months, January, February. After that point, I'm not really sure what the CPI data will hold for us, but I do think that we might see some spikes and let's say quarter 2, quarter 3. It's very possible we might see some spikes in the CPI data. And again, I think rather than looking at lagging data, I think that the TIP-TLT, which is something that we've been relying on, and it's actually been very right. TIP-TLT has been telling us and really guiding us. And if you notice on this, if you want to go back to some of our earlier episodes, I think it was around June or July or so. Let me go back to the TIP-TLT chart real quick. Back in June or July or so, right around here, it was around mid-June, I said that, with this type of TIP-TLT price action, we could probably see a lower than expected CPI print 6 months from then, around November, December. And that's what I said back here in June. Lo and behold, the November CPI report, guess what? Lower than expected, right? And so usually the TIP-TLT chart is a forward-looking indicator. It's the market's expectation of inflation. And again, I think this right here from like September to October, I think this is an anomaly. Okay, and again, this was because of the last inflation-protected treasury offering over 9%, and there was this huge bid from retail, some institutional, but mostly from retail. There was this huge demand for retail, and retail just piled into inflation-protected treasuries right here, and it kind of distorted the TIP ETF. And so I think this right here is just an anomaly. I think really if it wasn't for that retail participation in the last round of that 9% inflation protected treasury offering, I think it would have probably just chopped around this box. Remember, the expectation was that it was just going to chop around this box. I mean, lo and behold, after about 3 or 4 weeks of this anomaly, the market kind of normalized again and went back into that box. Okay, and now look, we're poking above that box. Do we poke back in? Possible. We might see that possibility, and so I do think that this is probably going to be range bound until we see commodity prices come back closer to March or April, when planting season happens, with planting of corn and grains and such. All right. Somebody from chat is saying again, Zillow, Apartmentalist, Rents, Case-Shiller, Housing Index are all going down, and housing holds 32 weight. And once BLS CPI catches up to real time, then CPI can drop fast. Yeah, again, I do think that CPI will drop for the next couple of months. We might see another, I think we see another bigger than expected drop in this January report that comes out, and possibly in the February report. And again, after that, though, I am not really sure what the CPI will hold for us. And again, I'm just opening up to the possibility that we might see a spike in the CPI if commodity markets come back in March, April, which I do think it's going to happen. I do think commodities will come back, especially with the grains, also with energy prices as well too. And then we'll see what happens. And again, CPI is lagging data, so I think that spike is going to happen, again, closer to end of Q2, possibly Q3. And we might see that spike happen then. But yes, I think for the next 2 or 3 CPI reports, we might see lower than expected. And I think that's going to fuel a lot of the institutional demand, and possibly even retail inflow into some equities. All right. I do see that. So that's something that I'm anticipating for 2023. And if that's the case, I think then all of our plans will do very well. The precious metal space will do extremely well. If commodities come back, I do think energy comes back too. CPG, all those names that we're trying to get into will also do well too. But I think initially we might see some turbulence, especially in the first 2-3 weeks of January. We might see some volatility. So I'm just getting my mindset ready for that. And but I do think that once that volatility is over, and once that 31 days of tax after tax selling passes, which again, it should be around end of January, early February, based on what happened this year, I think that will be a good entry point into a mini bull market that we will see for a few months. And then after that, we shall see. Okay, we will see what happens. The data will tell us the way. We've been talking about the junk bonds ADL. I haven't really showed you this for this year, but junk bonds ADL for this year, for 2022, has been amazing. It started in 2021. We got a clear signal in 2021 that we were in a downtrend on the junk bonds ADL line. All right. And back in November, not just myself, but anybody who follows the bond market saw this coming. I remember not just myself, but other members like Toasty, who's also in our Discord. Toasty was talking about this back in November, December as well too. And we were pounding the table on this to lighten the load on tech. And we warned people not to be in bonds, and bonds were not going to be a safe haven. Look at what happened. Okay. So for me, at least, I don't know what other people use in their bond market indicators. I think Toasty also uses corporate credit as well too. But I use the junk bonds advanced decline line, and it gave us a clear signal back in November, December that we were going to see at least decreased liquidity and decreased risk on sentiment in any risk assets. And so we saw that coming, and lo and behold, every time has been a lie detector for these bear market rallies. These bear market rallies could not create a higher high. This is not a higher high, by the way. It was short just by 25 points out of 115,000. So it barely made a lower high. Okay, made a lower low again. Oh, so now this looks like it's a lower high. It looks like this could be again just a bear market rally for now. Okay, I do think though, if we are to start a mini bull market, we might see this curl up, and maybe this might be a higher low on the junk bonds ADL line. I'm not sure. All I will say though is that this decline so far, minus yesterday's numbers. Yesterday we had a decline of about 456, which is not bad, but so far these last how many sessions in a row now have we been? What is it? One since mid December, we have seen a steady decline in our junk bonds ADL line. I think since mid-December, there's only been one positive day and everything else has been declines. But the decline has been the slope of decline has been a little bit more shallow than usual. Usually we see like a drop, okay? After about 3 or 4 negatives, we start seeing really big decline numbers, like in the 600s, 700s, even up to 1,000. But we're not seeing that. It's very shallow for now. Okay, I'm not sure if that's because it's a year end or what, but we shall see. And I think the first week or so of January will definitely tell us. First week or two will tell us that, oh, is this just a shallow pullback, and are we gonna keep going up again, or is this really gonna drop some more? Okay, if it drops some more and it makes a higher low, and then we see 4 days in a row of advances, that would be, I think, a good signal to get long, at least for the next couple of months, or at least a couple of weeks in the market. Of course, that will take weeks to form. Okay, that will take weeks to form. Again, somebody from chat today. Chat is pretty active. Do you think stocks can bottom once Fed hits the pause button? Do you think stocks can bottom once Fed hits the pause button and CPI doesn't spike up? Do you think stocks can bottom? I think, yeah, definitely. I think stocks can temporarily go up if Fed pauses. And actually, let me back up here for a second. If you actually look at the Fed funds probability rate, what the Fed futures market is quote unquote predicting, they are set to pause. It's already the expectation that they're going to pause after the March 25 basis point rate hike. March, 500 basis points, 475 to 500. May, 475, 500. 475, 500 for June. July, 475, 500. September, 475, 500. November, again, 475, 500. But the odds of 450, 475 is pretty decent. All right. And then December, we're looking at a higher possibility of a rate cut. So already the market is already pricing in a Fed pause after March. Okay. And yes, if CPI doesn't spike until then, yeah. But you know what? Just from the data, okay, just from my initial thoughts, and also just looking back historically, and again, every moment in the market is unique, but history does tend to rhyme. Usually these commodity cycles, these super cycles, don't last just like a year or two. They usually last about 5 to 10 years. All right. And so, I do think that commodities do come back in March or April around planting season. And when that happens, that's going to affect costs. The raw material costs go up. Everything starts coming up. It's a domino effect. And sometimes it takes time. We actually saw commodities go up starting in 2021. 2020, actually. Some of the metals started going up in 2020. Energy prices really started going up in 2021. We really didn't see all the other, the end cost retail, end goods, services, all that really didn't show up in the quote unquote lagging data like CPI until 2022. Okay, so this has a lagging effect. So if commodities come back in, let's say, March, April in that planting season, again, that CPI, it probably won't spike until, again, around like second half of 2023 when inflation comes, the inflation readings roar back. I think it's going to roar back around end of 2023, early 2024. I've been talking about this for months. And I think at that point, too, we're going to see some solvency issues in emerging markets. As inflation expectations go up, the dollar will go up in anticipation of a tightening Fed. And if the dollar goes up and all these debt servicing costs that emerging markets have on bond debt, and most bond debt is denominated in dollars, if the dollar keeps going up, the price of that debt will go up. And then all the raw materials and the food that the emerging market countries have to import, they will go up because most commodity trade is denominated in dollars as well too. That could put a lot of pressure on emerging markets. A lot of countries already were pressured because of this. Look at Europe. Look at the Bank of England. Look at what they had to do. They had to get involved in their bond market after their first rate cut. They actually had to start buying bonds again to save their national pension. All right, and that's England. That Bank of England. We're talking about Great Britain here. We're not talking about some, quote unquote more traditional emerging market. and now it's kind of debatable whether or not Great Britain is an emerging market itself. But that's a discussion for a different day. But I do think there's a lot of emerging market countries out there that are going to show these cracks toward the end of 2023, early 2024. It does take time for these cracks to widen and really become like a huge hole in the ground. I think China is a very good potential place where we could see that crack, especially if their real estate speculation grows because of all the liquidity that they're injecting right now into the market. That's a good candidate for this. Europe might be a candidate for that. Japan might be a candidate for some type of solvency issue. Probably Great Britain, again, they might have some solvency issues. We might see some Southeast Asian countries have some issues. Although the silver lining in all of this is India looks particularly strong, actually, in all the emerging market countries. India looks particularly strong. Also, too, some of the commodity exporting emerging market countries, they also look relatively strong against their peers as well, too. So I don't, it's going to take some time. I think it's really going to take some time for it to manifest itself. And usually market phenomena, much like phenomena in nature, tend to be a little by little in the beginning and then all at once at the end. Okay, so it's usually a small trickle and then a gush at the end. So I think right now we're in the beginnings of the trickle stage, and so it will take some time for this to manifest. And again, I can't predict the future. Nobody can. I'm just anticipating not just 5 or 10 moves ahead, but now about 10 to 20 moves ahead. And that's what today's episode is all about. It's all about what worked for 2022 and what we're anticipating for 2023. So this is kind of the themes that I'm looking for so far for the 2023 investment year. Okay. Oh, speaking of which, if we do see a mini bull market where we see this, we see institutional demand come back, especially for the tech sector, that would probably put some tailwinds to crypto as well, too. That's more of a fringe, I guess, thesis. I'm not sure, because right now crypto just looks dead. If you look at the options chain, also dead. No really big trades, not much big speculation. Although I do think that if junk bonds really does improve, credit conditions improve, and we see a risk-on sentiment, and we see this mini bull market last for a couple of months, we could see crypto at least make a temporary comeback. But again, once that solvency issue hits, who knows? I mean, that could really tank this. Maybe that might be the final washout before crypto comes back for a longer bull market. Again, I think that's years in the making. But we'll see. Okay. I do think, though, if the market comes back for the first half of 2023, we will see crypto come back. I don't know about it going back to all-time highs or anything like that. I don't think that's plausible, but we could see a retracement of this loss, perhaps up to 30 to 35,000 or so in Bitcoin and Ethereum. I could see it coming back up to 2,500s or so. All right. But then after, we see problems if the dollar keeps coming up again and, inflation worries increase, and if we see a growing fear of an even more hawkish Fed down the road in the second half of 2023, then all bets are off. Ethereum and crypto is going to sell off. Any type of non-cash producing asset is going to take a hit. Okay, dividends, free cash flow, that is inflation protection. Okay, getting paid cash to wait, that is inflation protection. There is no cash you can make from it. I mean, I guess you could stake ETH. You could stake ETH, and right now I think the staked ETH rate right now is around 3 to 4%, if I'm not mistaken. Right. So I wouldn't want to be very heavy in crypto if by second half of 2023 all our thesis plays out. Okay, it might be a good trade for the first half of 2023, but if our thesis plays out, then end of 2023, 2024, probably not going to be a good time for any risk asset, really. That will be, if our thesis plays out, if I'm right, that will be probably the biggest recession / depression in most people's lives living today. Okay, it'll be something like we've never seen before in our lifetime. Okay, I wouldn't say it's going to be like the Great Depression, like in the 1920s and 30s. I don't think it's going to be that bad, but it'll be a deeper recession than what most people think. Okay. And a lot of people are calling for that in the first half of 2023. I just don't see it. I don't see the data supporting that. I do see it though as a possibility for end of 2023, beginning of 2024. I think that's a possibility. All right. So I just want to be clear on that. Oh wow! Look, we're getting past the 1 hour mark on this. Anything else you guys want to look at? Anything else you guys want to look at? All right. I know a lot of people are joining us from YouTube, and there's about a 20 or 30-second delay from what I'm saying and to chat. So I'll give you guys about 20 or 30 seconds to reply back with any questions or comments or any rude remarks you have. You know, this is our final episode of 2022. We'll be back on next week. You know, same schedule every Tuesday, Wednesday, Thursday, 30 minutes after the opening bell of the New York Stock Exchange. We're going to have the market memo. Monday is a holiday. It's the observed New Year's. And so the markets will be closed on Monday the 2nd. So keep that in mind, guys. It's going to be a 3-day weekend again this coming up weekend. So enjoy yourselves and make sure you get lots of rest. We're going to need it. I think January is going to be one of those crazy months. And February as well, too. I think a lot of opportunities will present themselves in January, February. Some more chat. When do you think mini bull market will happen? I actually think, again, you know, based on the tax selling that happened this year, I think it happens sometime in the end of January, early February. I think that's when it happens. Okay, that so far, just from the data, just from the block trades I've seen, a lot of the block selling happened around that second week of December. It started happening where we saw oil and energy names being sold off in pairs with semiconductors. You know, the biggest winners and the biggest losers had a big block trades happening at the same time. And I think that was the start of the tax selling. And that happened around the first, I believe it was the first or second week of December. So usually, and it still intensified into this week. So, wash sale rules are, you to avoid the wash sale rule, investors and traders need to wait 30 days, and on the 31st day they can rebuy that security and avoid a wash sale. Okay, and so that moment comes around end of January, beginning of February. So that's where I see the mini bull market starting there, okay? And at the same time, okay, and again, I'm going to let you, you know, every day I'm on Discord. I do this morning market memo 3 times a week. We will know, okay? It won't be like, we won't have to guess when this happens. There will be signs of this. We'll start seeing block trades happen again. We'll see dark pool trades happening on the buy side. We'll also start seeing liquidity conditions improve. Generally, we see our junk bonds advanced decline line, also our New York Stock Exchange high-low line, they will start curling up, all right? And if we see all of that, okay, we start seeing big buy purchases in tech names. On the end of January, we see the junk bonds ADL line curving up 4 days in a row of advances over declines. And we also see the New York Stock Exchange high-low line, all right, curling up. That would be the sign. And I think that happens around end of January, early February. And again, just stay tuned. I'm going to, you know, I'm going to post all this stuff. So we'll definitely be prepared for this, okay? It's not going to catch us by surprise. And DXI might retrace on, again, it's from chat. Today chat is pretty active, and DXY might retrace 108 before mini bull market. That I don't know. I don't know if DXY, I mean, I have hedges positioned for that. I would love to see a retracement to 108. Believe me, man. I would love to see that. But, you know, what I want versus what the market's going to give me, 2 different things, okay? I am hedged. I have some UUP calls that are my hedge for some of the positions I have, just in case if the dollar spikes and sends like Quad U, which is a metal miner, it's a uranium miner, but those kind of mining stocks are very sensitive to dollar moves. So I do have some UUP, which is the ETF for the dollar index. Hold on, let me show you just so you know that I'm not lying to you guys. Okay. What is going on? Okay. So yeah, I still have the January 2024 calls. Okay. I still have them. All right. They're a little bit underwater. I just have enough to hedge my UU shares, my Quad U shares. So yeah, I would love to see 108. And if the dollar retraces to 108, guess what's going to happen to the price of silver and gold? They're going to come down, and that will be a huge buying opportunity for the silver miners. And again, I would love to see that. I would love to see that. But are we going to get it? I don't know. I'm just anticipating. I'm not trying to predict the future. I'm just anticipating 5 or 6 moves ahead with that. Okay? Hope that answers your question. All right. Anything else you guys want to look at? Any other questions, comments, rude remarks? Today was a pretty active day, especially on I think this is YouTube. We're on multiple social media channels. So today I'm seeing a lot of activity on our social media chats. So if you guys are new to us, welcome. I'm honored that you have chosen us and decided to spend your time with us. We have a Discord for Checkmate trading. It's free for everyone to use. You can join in and talk to us even after the market memo about your trading ideas or your investment thesis. We like to bounce ideas with one another. We do it for the education, and we do it for the people. All right. Any other questions, comments, rude remarks, anything else you guys want to see? Again, from YouTube, what if Fed hikes 25 basis points with a hawkish tone in Feb and then validates its thesis of a bull run starting in February? Could be. If they have a hawkish tone, it could be. It could very well be. But however, even if they do have a hawkish tone, the bond market has to react to that tone. Okay? In the end, the bond market is king. All right. Everybody thinks that the bond market reacts to the Fed, and I think it's the other way around. The Fed reacts to the bond market. Okay. There's a famous political strategist. I think it was Bill Clinton's political strategist, and he said that if reincarnation were a thing, and if he were to be reincarnated, he would want to come back as the bond market because everybody has to listen to the bond market, and that is true. The bond market is king, okay? It's one of the biggest markets out there, way bigger than the stock market. Stock market is like a little bro. It's like a little infant compared to the bond market, okay? The Fed follows the bond market. It's not the bond market follows the Fed. So in the end, even if, I highly doubt that Jerome Powell is going to have this hawkish tone if we see a CPI drop in January, February. But let's say he does. It really just depends on the bond market reacting to that hawkish tone. If the bond market doesn't react to that hawkish tone, then it doesn't matter. Okay, because in the end, the bond market is king. All right, and the stock market is going to take its cue from the bond market. All right. Most professionals that I know, I'll tell you this, most professionals I know, they don't actually listen to the Fed speech. Even at the institutional desk, when I worked when I worked in trading, they would hand out transcripts to everybody, on the trading team, but nobody really read it. Everybody, though, but a lot of bond market reaction, a lot of bond market metrics for that day and for the next couple of days, that was heavily analyzed and scrutinized, though, after a Fed meeting. Usually, they would be looking at the bond market, looking at shorter-term yields and Fed futures markets and Eurodollar swaps and things like that. That would be the more of the focus after a Fed meeting. But the actual Fed speech itself, most professionals don't even listen to it. And again, because it doesn't matter. If you really follow the Fed and you really know the bond market and you follow the bond market, it's the bond market's it's the bond market that really sets the tone. Okay, if you look at the dot, and people put all this focus on the dot plot of the Fed. Let me plot the dot plot against the 2-year Treasury yield. Tell me what you find. They are in lockstep with one another. And that's why you hear a lot of people, especially these like bond vigilante types, they're saying that, oh, the Fed, we should just replace the Fed and just have a policy just based on the 2-year yield. Okay. That's a totally different debate for a different day. But you look at the dot plot and and you plot the 2-year Treasury rate with that, again, lockstep with one another. Okay. All right. Any other questions, comments, rude remarks? Going once. Going twice. All right. Then in that case, we will wrap up our session of the morning market memo for the day. All right. So our Discord invitation link is in the description below. Come join our Discord. Be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right. Again, next week, Tuesday, Wednesday, Thursday, I'll be back for morning market memo, 30 minutes after the opening bell of the New York Stock Exchange. Remember, Monday, January 2nd is a holiday. It's a market holiday. Markets will be closed. Enjoy your 3-day weekend. Rest up, because I think January, February will be some pretty good opportunities showing up. So be well rested, and Happy New Year, guys. And I wish you all the best of fortune in 2023. All right, guys. Happy New Year. We'll talk next week.